Every major financial crisis ends with the same scene. Politicians step in front of the cameras speaking calmly, bankers put on serious faces, and a wave of hastily drafted laws is pushed forward for the good of the people. The message never changes. Don't worry. We've learned our lesson. We'll fix everything this time. But history has heard that line too many times, and it shows that nothing really changes. Because many of the laws passed after financial crises weren't designed to protect the public at all. Their true purpose was to keep the system standing. And that system is nothing more than banks, credit markets, and the tight alliances governments build with them. This story didn't begin in the modern era. In 1800s England, banks printed their own banknotes, credit kept expanding, and trust collapsed into frequent panics. The 1844 Bank Charter Act was marketed as a way to stabilize money for the public. But the reality was very different. It handed the Bank of England near total control over issuing money. Small banks were pushed out, competition narrowed, and central banking became the dominant force in the country's financial life. It was never a law created to protect citizens. It was a mechanism built to protect the system itself. The same script unfolded across the Atlantic. During the U.S. Civil War, the government was drowning in costs and introduced the National Banking Acts. These laws were advertised as a step toward creating a unified, trustworthy currency. But the real design was far smarter. Banks had to buy government bonds if they wanted permission to issue banknotes. This effectively turned banks into captive buyers of government debt. While people believed this was financial modernization, banks enjoyed the comfort of having a guaranteed, state-approved role in money creation. Time moved on. During the Great Depression, thousands of banks collapsed, and millions of people saw their life savings disappear. To calm the public, the Glass-Steagall Act was passed. Separating commercial and investment banking was pitched as protecting your savings from Wall Street. That was partly true, temporarily, but the law didn't change the deeper structure of the banking system. Its main function was to restore public trust. Decades later, lobbying gutted the law and essentially eliminated it, helping pave the way for the 2008 crisis. FDIC, deposit insurance, born in the same era, was also advertised as a shield for ordinary people. And yes, knowing your money is safe if your bank collapses sounds comforting. But that insurance detached banks from the natural discipline of risk. Citizens stopped monitoring banks' behavior. After all, the government was standing behind them. This encouraged banks to take bigger risks, knowing they wouldn't be allowed to fail. What looked like public protection became a safety net for banks. One of the most controversial moves of the Depression era was the 1933 Emergency Banking Act. The government shut down banks nationwide, freezing the country. Then people were told to turn in their gold for paper dollars. The public was told this was a patriotic sacrifice to revive the economy. But in practice, it transferred real wealth from citizens into the hands of the financial system. The state-bank alliance grew stronger than ever. These patterns didn't vanish. They simply grew larger over time. The 2008 crisis is the clearest example. When toxic mortgage securities exploded, millions lost their homes, jobs, and savings. But the giant banks at the center of the disaster were rescued with packages like TARP. Lawmakers claimed this was necessary for the whole economy. But the winners and losers were obvious. Banks survived. People paid the price. Europe replayed the same performance. Across Ireland, Spain, Greece, and Portugal, governments absorbed bank debts. The burden returned to citizens through austerity, higher taxes, and cuts in public services. The 2012 European Stability Mechanism was marketed as a shield protecting citizens from future crises. But in reality, it created a permanent rescue fund designed primarily to save banks, not people. And ordinary citizens ended up footing the bill. This system isn't limited to national laws. International frameworks like the Basel Accords were supposed to limit bank risk-taking. Yet in practice, they offered clever loopholes for global megabanks. Risky assets could be treated as low risk with government backing. Shadow banking grew. Balance sheet manipulation became normalized. Today, the same structure still operates. When central banks raise interest rates, they claim it's to protect you from inflation. But their real priority is the stability of the currency and credit system, the system itself. Deposit insurance makes you feel safe, but reduces the pressure on banks to act responsibly. Bailout programs are described as saving jobs, but they mainly stabilize corporate and banking balance sheets. And laws restricting